Paul is one of the co-founders of Psychometric. They're a risk profiling company. They developed it in conjunction with the University of New South Wales Applied Psychology Unit a number of years ago. And this is typically used by financial advisors to try and assess clients' in risk profile. So, Paul, how are you this morning?
Well, here in Melbourne, it's a beautiful morning.
So I thought perhaps we could start off, perhaps if you could just explain to people what is risk profiling and why is it so important?
Well, each of us is different in terms of both our psychological attributes and what we want to do with our money. So if I could try and put it into a context for you, a risk profile is essentially made up of four ingredients, four pieces, and each of us ends up with a unique proposition. Two are psychological and two are contextual. Psychologically, there's your tolerance for risk, which is a fairly steady personal trait. There's your perception of risk, which tends to shift with market noise. People are confident when markets are going up and less confident when markets are going down, what their friends are saying. So those are the two psychological attributes. We measure the first one, the steady state, if you will, an individual's attitude to risk. And there are two others, what you want to do with the money, which we call risk required. What sort of mix of assets do you need to do to achieve a particular goal? And the final one is risk capacity, is what can you afford to lose of that? Do you have a way of substituting if there's a loss? Can you still meet the obligation that you've set for yourself? So the risk profile is a combination of those four, and they need to be teased out. Traditionally, questionnaires brought all four questions together and said, you're an Aquarian investor or you're a balanced investor, and gave you a portfolio. With a good advisor teasing those four bits out, you actually get a portfolio that meets your needs.
And actually, that's along the lines of what you were saying earlier, Rob, in terms of the risk tolerance. So just a little bit earlier, we were talking about risk profiling there, Paul, and Rob was saying that he was saying, look, as people get older, doesn't their risk profile get lower and lower? And I was saying that there is a different aspect. So if I recall, I've recently read a paper that you guys had written on the stability of risk tolerance, where you were arguing that an individual's risk tolerance doesn't change. Now, and I was then starting to think, okay, well, how can that be? You know, because I'm seeing a lot of investors coming in to see me, for example, where they're saying, look, I just don't want to invest in the share market anymore. I'm petrified of the share market, and they seem more risk averse than ever.
Yeah, I think that this is a little more than an argument about meaning of words. But let me just try and separate out. People's perception of risk is exactly what you're dealing with here. If you remember, I said there are two psychological attributes. There's the risk tolerance, which tends not to change. It ameliorates a little bit with age, but essentially it's an enduring personal trait. And perception of risk, which moves with the wind. If you don't separate them, you mistake one for the other. So what you have at the moment is a great fear of consequence, because all the news is bad. All of our friends, all of the newspapers, the media are saying things are bad, and we tend to get carried away with it. Now, the danger of that is we actually start acting upon it. And the classic way that resolves itself is things are bad, therefore we'll either sell quality assets because the price seems low and they're going further down, or we won't buy them. We're going to wait for the market to recover. Markets don't wait for anybody. The markets will recover, and when they do, they tend to come very quickly. So if you say to yourself, I'm going to wait until the market's recovered, you will have missed the recovery. So that's the problem. If you don't separate perception, you'll end up making bad decisions. If you wait till the market's recovered, you'll have bought at the top and you'll be disappointed with the performance. So you're quite right, people are feeling uncomfortable and nervous, but that's because risk perception is dominating their decision making.
Paul, just on that point, it's a very interesting point, and certainly the markets do seem more less certain, I might say, and hence with property and the stock market, less people are sort of comfortable getting involved. If you're separating the one between how you are as a person, how you sort of psychologically you react, but then you're also looking at the markets. If markets become more volatile, and hence you perceive that they're more risky than they normally might have been or they were in the past, does this naturally lead to less people being involved in the market? And then when markets look like they're going your way, there's a bit of sheep mentality and herd mentality. People pile back into the markets. Is this an explanation as to why we have peaks and troughs and boom and bust?
I suspect so. At its most vulgar, we're herd-like creatures. We feel more secure when we look and sound like our peers. So we tend to dress like our peers. We tend to send our children to schools like our peers. We tend to drive cars like our peers. We tend not to want to stand out from the crowd. And I was reading the other day the sort of classic argument when we were coming out of the cave and we were exploring and looking for something to eat, you never wanted to be at the edge of the group. That they were the ones that fell over the trees, were eaten by bears, that were mauled by tigers. You always wanted to be in the middle. So our natural position is to be in the middle of the herd. It works in many ways. It just doesn't work with money.
Does it mean
that's where the juxtaposition comes in?
Does that mean that there are better? I mean, if you don't look at what everybody else is doing, that you are naturally a risk taker, or your risk profile is higher if you're doing things on your own.
Gosh, that's an interesting argument. I can't find any direct correlation between control and risk tolerance, if that makes any sense.
Yeah, I don't mean if they're controlling you, but if you take the stance that you will make all your own decisions and you won't look at what everybody else is doing, you'll make your own judgments. So in other words, you decide when you go in the markets, irrespective of what everybody else is doing. Does that imply...
That might be an outcome. I think what I was about to allude to was actually the contrary to that, that once you recognise that you're a victim of emotion, you need to reduce your activity to a formula, if you will. And the formula that seems to work around the world is you decide on an asset allocation between growth and defensive assets that you think you can live with in terms of risk capacity and risk tolerance, and you maintain that formula. So let's say your risk tolerance is normally distributed. You score 50 out of 100. Typically, you could say, I will have 55% of my money in growth assets and 50% in defensive assets. And every year you review your portfolio. If shares have gone up, you sell some. If shares have gone down, you buy some. And you bring back. So that's one way of de-emotionalizing, if you will, the decision-making. What that should do is it won't give you fantastic returns, but it will provide a basis that you won't lose huge amounts of money. It's a way of sort of standardising.
And I'd argue that that's that is what a good advisor should help you do. And the whole thing behind risk profiling is to try and stop investors pulling out at the bottom of the market and then waiting till the market recovers before they buy in at the top. We get caught up in this roller coaster of investment behavior. So, Paul, I did have a question just along those lines. That are you really just talking about behavioral finance? Is that what you do?
I think that's right. That's a good question. Are we talking about behavioural finance? I think the answer is yes. If I could just give you a quick definition, and this is a sort of very vulgar. Economists assume people behave rationally to maximise their wealth. Behavioural finance people realise that people behave emotionally with what they do, and because it's behavioural finance, they're emotionally with their money. The interesting thing is that there are patterns of behaviour, and it's not that having resolved not to be economically rational, we decide that we're just going to be emotionally rational, and each of us is different. In fact, the patterns are very specific. So I go back to if each of us believes that having a local property, some shares in the bank, some woolies, and some term deposits is a diversified portfolio, then we'll believe it's a diversified portfolio because that's the group think behaviour. And what behavioural finance is trying to unravel is some of those patterns that we tend to, for instance, reflect on what we know. So there's a bias to local. There's a recency bias. We tend to remember the last half dozen bits of news, not what happened 5, 10, 15, 20 years ago. So yes, it's bringing into play the patterns that are reasonably predictable about how we will behave with money, and making sure that they don't dominate to the detriment of our investment portfolio or our client if we're an investment advisor.
And Paul, what typical types of differences do you see in certain groups? So, for example, men versus women, and also the occupation you might be. So we were talking a little bit earlier about the risk profile I did last night, just before you came on air, and I was saying how I came out as my tolerance for risk as being quite high. And I'd done one of your profiles back in 2004, and it had come in as being quite high back then. And I was surprised because I've had kids in the meantime. I feel that I'm actually a lot more cautious these days.
Yes, I suppose that's the classic challenge for people in our industry. People in financial services are more risk tolerant than the general population. And one of the surprising things that we now know is education doesn't change risk tolerance. So just doing your own test should have shown you that you need to be very careful not to project your risk tolerance onto your clients. Now, I actually had a look at your report, and your self-awareness as opposed to your final score, there was quite a gap. And that's certainly not unusual. So I think from memory you scored 76, which puts you in the top less than 0.5% of the population.
I don't think that's a good thing.
99.5% of the population have a lower risk tolerance.
So he's got a high risk tolerance. Is that what it means, Paul?
Yeah, you've got a high risk tolerance, yeah. And the challenge is that in financial services we assume that we're normal, and we're not. And that's why your gap between your self-assessment and your actual score was 6 points. Isn't huge, but is quite reasonable. Sometimes I see it for people who've got a high risk tolerance, their awareness of where they think they are. They think they score 60 or close to 50, which is halfway between the process. So in financial services, we tend to be more risk tolerant, and we need to be very careful about how we project our own risk tolerance.
What are the sorry to interrupt there, Paul. What are the dangers? I mean, there's obviously an end use for this information, and it's obviously very interesting, but it also has a purpose. What are the things we're looking out for that we should be aware of? Because people can do your risk tolerance. Can they do it online?
They can. We have a website called myrisktolerance.com.
So the people can just go to my risk tolerance.
Test there.
You can go to myrisktolerance.com. They can do their own profile. what should they then look for?
Well, what we do is we do two things, I guess. We show you your risk tolerance against the population. So it's good to know where you are compared to everybody else. And we use some statistics for that. We use what's called a bell curve. Many of your listeners will be familiar with it. We simply say risk tolerance is distributed across a broad spectrum. The vast majority are in the middle, score 50. But we have two extremes, and you're one extreme, you're very risk tolerant, and you're in the top 1%, and there are people at the other end, the bottom 1%, they're risk groups. We're divided up into 7 risk groups. What the report will say is where each individual is compared to the population and how they're different from others in the risk group. So we report what we call differences. So typically, once again, if I remember yours, you were in risk group 7, but you had 6 variations. And those variations, there'll be a reason for it. So if you were my client, I would explore with you why those differences occurred. Was there anything that had gone on in your thinking, in your education, in your experience that may have driven that? If you had a life partner, I would suggest that she did the test and would discover that there would be differences. It's more often than not, women are one risk group less tolerant than males, but that's on average. And sometimes it can be 3 or 4, and sometimes it can be the reverse. The male is risk averse and his partner is risk tolerant. So averages are dangerous. That's why it's worth drilling down to the individual level. So what you'll get is a report. It won't tell you what asset allocation to buy. It will just start you thinking about why you're different. If you're going to build your own portfolio, you'll learn a little bit. If you're going to an advisor, you're already going to an advisor or intend to go to one, it's probably a good starting point for a discussion with the advisor. I did the test. Told me what I was. Can we talk a little bit about how you would incorporate this, Mr. Advisor, in the advice you might give me in the future?
And does this apply to your life? As I'm just thinking now, we're thinking about women. You said that generally if you split the sexes, women would be one risk group lower, and thank God that they are maybe in some respects. But that reminded me of a fact that in Japan, women control the money in the household, and women are a large part of the investment in foreign currency and shares and things like that. And that worries me. But is this risk profile, it's something that you can apply to other, not just finance, but just the way you treat your life and the decisions you make generally?
Well, it's a very good question again. We measure financial risk tolerance, and I want to juxtapose that from another tolerance, physical. There's no correlation between how brave you are, whether you climb outside of buildings or you go paragliding, and financial risk tolerance. It is a separate trait. So ours is constrained by finance. Now, finance is a much broader term than just investment, and up until now we've just been talking about investment. So we test a much broader set of issues to see how people think. But you raised a very good issue. We tend to invest consistent with our risk tolerance and our experience. Imagine what it would be like if you were a Japanese woman. Here is a society which is massively conservative, has had no stock market performance of any consequence for 30 years, has the biggest property bubble failure. A diversified portfolio would barely have kept going with inflation. Why wouldn't you be investing in Australia paying 5 and 6%, not understanding the currency risks that you were taking?
So is that would relate back to your risk perception, really, wouldn't it? Because their perception of risk would be very, very different to, say, a housewife over in Australia.
I think that's right, yeah. Our perception of risk, we work in 20 countries, and so everyone is different. While the language of risk profile, risk tolerance seems the same, the local experience is extraordinarily different. So I've just come back from India, and for those of your listeners that remember, India, after probably 50, 60 years of not a great deal happening, has a burgeoning economy over the last while. So the Indian middle class is investing back in India, and they're investing back in India with their ears pinned back. And so they're running what we would call concentration risk because of their recent experience. And before there wasn't growth, but now there is. They just invest in Indian stocks. And what will happen in due course is they will be bruised by a correction. Some of them will withdraw, saying, well, my expectations were it would keep going. Nobody told me. You know, the classic line I hear around the world is, nobody told me how bad this can get.
Yeah, and
all of the marketing was about upside.
And would you say
the actual experience is a diversified portfolio will grow at 1.5 to 2 times the bank deposit rate in the longer term, but volatility will be still quite large.
And would you say that's a similar experience to maybe how we're sitting here in Australia, say in the property market? Because the experience in the property market here has been phenomenal. And that's a thing I hear time and time again. So far, exactly. Rob actually just raised a good question. He just faded himself out a second ago. Was do you think we see any big differences in terms of the Aussie investor? Why are we so keen to go and plough money into things like the pokie machines over here, relative to, say, compare that to, say, the Japanese housewife who's had a very different experience there?
I think if you think about the Aussie investor, didn't have the trauma of 2000. If you're an American or a POM, you would have been traumatized by the tech wreck. We didn't have a huge exposure to that. So we had a very gentle run from the recovery after 87. 2008 was a pain, and then we haven't had a really good recovery. If you look at the US market, it's now well past 2008. So the Americans have been investing, I saw the other day, more Americans investing in the stock market than ever, in terms of new money. And that's basically because the performance is now there. When should they have been investing? Well, in retrospect, in 2008.
Okay,
so
well,
every country's history will colour how people feel. And I suspect the Australian one is 2008 was such a shock. There wasn't 2000. And the recovery has been much slower.
Okay, well, look, thanks for your time, Paul. Can you just mention how listeners might be able to access your risk profile again?
Thank you. I'm afraid you just broke up on that last.
I was just saying, can you just mention again how listeners might be able to access your risk profile if they want to do their own one? Are you saying that they can do it online?
Yeah, I think we charge a little bit for doing the test, but I think people will find it worthwhile. So it's myrisktolerance.com, and I wish your listeners well, and I wish you well. Thank you very much for the opportunity to share what we know.
Thanks very much, Paul.
Yeah, thank you, Paul. That was very interesting. That's Paul from Psychometric. Thank you very much. Cheers, Paul.